Let's talk about a question that every serious trader eventually asks: who really moves the markets? When you look at a price chart, those candles ticking up and down, it's easy to think it's just buyers and sellers creating movement. But the deeper truth is much more complex, and frankly, much more calculated. The market isn't just random. It's a battlefield of strategies, deception, and manipulation, and at the top of that battlefield sit the big players: institutional traders, hedge funds, and investment banks. These are the market makers, the liquidity hunters, and the architects behind most of the price action you see. If you don't understand how they operate, you're playing a game where the rules are designed to work against you. So in this video, we're going to go deep. We'll break down exactly who moves the markets, how they move them, and more importantly, why they move them in the ways they do. We'll cover how the big banks use advanced algorithms, how they manipulate retail traders with fake outs and liquidity grabs, and how you can begin to see the signs they leave behind. Because once you start understanding the real mechanics behind price movement, you stop being bait, and start thinking like a shark. Let's begin with the basics. Who are the major players in the market? The most powerful forces in financial markets are large institutional participants. We're talking about banks like JP Morgan, Goldman Sachs, Morgan Stanley, and hedge funds like Citadel, Renaissance Technologies, Bridgewater, and others. Then there are large mutual funds, pension funds, and sovereign wealth funds that manage hundreds of billions, even trillions, in assets. These players don't enter or exit trades the way a retail trader does. They don't place a market order with 100 shares and hope for the best. They move size, massive size, and because of that, they need to be strategic. Every large order they place can move the market against them if they're not careful. So they hide their intentions, they spread their orders across time and across platforms, and they often manipulate price action to create better entries and exits. This is where liquidity comes into the picture, and this is the part most retail traders miss. Price doesn't move just because people are buying and selling. Price moves to where the liquidity is. Think of liquidity as the fuel that powers institutional trading. Without liquidity, their trades would slip. They'd be forced to buy too high or sell too low. So what do? They hunt it. They create setups in the market to draw in liquidity, and then they capitalize on it. Let me give you a concrete example. Imagine a stock is trending upward, and retail traders start piling in. There's a clear resistance level forming at $100. Over the next few days, that level is tested multiple times, and traders set buy stop orders just above that level, expecting a breakout. But the big players, the smart money, they see this. They know where those stop orders are placed. So what do? They push price slightly above the resistance level, triggering all those stop orders and trapping retail traders in long positions, and then immediately reverse the price, driving it back down. What just happened? They engineered a liquidity grab. They used the expectation of a breakout to lure in orders, fill their own short positions, and then dump the price, leaving retail traders holding the bag. This kind of move happens constantly, at highs, at lows, around key psychological levels. It's often referred to as a stop hunt, a fake breakout, or in smart money circles, a liquidity sweep. The big banks don't chase price, they wait for liquidity to become visible, then move price to that liquidity. They want to be the ones selling into retail euphoria, and buying into retail panic. This is the opposite of what most traders are taught. Traditional technical analysis teaches you to buy breakouts and sell breakdowns. But smart money is usually fading those moves, because they created them in the first place. Now let's talk about how this happens on a technical level. Large institutions don't place manual orders. They use algorithms and execution models designed to break up large trades into smaller ones and execute them over time. These algorithms are programmed to analyze order books, track volume, monitor liquidity levels, and most importantly, respond to retail behavior. Some are designed to do iceberg orders, where only a small portion of the order is visible at any one time. Others use dark pools, where large orders can be placed without showing up in the public order book. That means what you see on your level 2 or your price chart is only a small part of the picture. The real action, the real volume, is often hidden. Smart money also uses something called liquidity zones. These are areas on the chart where retail traders are most likely to place their stops or limit orders. The most common ones: previous highs and lows, round numbers like $50 or $100, and major support or resistance levels. Think about it, how often have you placed your stop just below support, only to get wicked out by a sudden candle, and then watch the price continue in your original direction? That's not random. That's engineered. The institutions push price into those zones, absorb the liquidity, meaning they fill their positions, and then allow price to reverse. In Forex, this is especially common. The Forex market is decentralized and extremely liquid, making it a playground for institutional order flow strategies. Banks and major liquidity providers monitor the positioning of retail traders using data from brokers, and they strategically move price to clean out those positions. The result? Retail traders feel like the market is against them, but in reality, they're just playing into a system designed to extract liquidity from weak hands. Now, this doesn't mean retail traders are powerless. Quite the opposite. Once you understand these mechanics, you can begin to spot them. You start to see where liquidity is likely to sit. You stop chasing breakouts and start watching for liquidity grabs, false moves, and trap candles. You begin to trade like a predator, not prey. Let's break this down with a specific scenario. Suppose a stock has been consolidating in a range. You've got clear support at $95 and resistance at $100. Retail sentiment is bullish. Everyone's waiting for the breakout above $100. You see it on Twitter, in Discord groups, on Reddit. The hype is building. Then suddenly, boom, a green candle breaks above $100. Everyone piles in. But here's the catch: the volume isn't explosive. There's no confirmation. Price stalls just above the level, maybe pushes to $101, and then sharply reverses. Within minutes, it's back under $99. What just happened? The breakout was a trap. The big players triggered the retail orders, filled their shorts, and let price collapse back into the range. This is liquidity manipulation in action. Another tactic big players use is false support creation. They'll intentionally defend a level, say $95, multiple times over several sessions, making it appear as strong support. Retail traders get comfortable. They place their stops just below, maybe at $94.50. Then one day, without warning, the price slices through $95, triggers all the stop losses, spikes down to $93, and reverses. Again, a stop raid. The smart money now has all the liquidity it needs to build a long position, at a better price. And this is why smart traders study order flow, liquidity zones, volume anomalies, and price manipulation structures, rather than relying purely on indicators. The market isn't a straight line. It's a narrative. And the big players are constantly writing that narrative in real time, using psychological levels, retail behavior, and engineered volatility to fill their orders. You might be wondering, is this legal? The short answer is yes. These are strategic executions, not crimes. Banks and institutions are allowed to act in their own interest, and creating liquidity events is part of how they execute large positions without slippage. What is illegal is spoofing, where traders place large fake orders to manipulate price and then cancel them, but even that can be difficult to detect or prove. For the most part, this is just the game, and knowing the rules is the first step toward winning it. So where does this leave the retail trader? Should you give up? Of course not. You just have to stop thinking like a retail trader. Start tracking liquidity. Use tools like volume profile, footprint charts, and market structure analysis to identify zones of interest. Think in terms of where liquidity sits, why price is moving, and who benefits from that move. Understand that every candle is telling a story, and your job is to read between the lines. In conclusion, the market is not a level playing field, but it is a learnable one. Once you stop seeing the market as random, and start viewing it as a system engineered by large players to facilitate their own positioning, you unlock a new level of understanding. You see the traps, the games, the manipulation, and you learn how to position yourself with the smart money, not against it. Thanks for watching. If this opened your eyes to how markets really work, drop a like and subscribe. Let me know in the comments, have you ever been stopped out just before a reversal? If so, chances are you experienced a liquidity hunt firsthand. We'll be covering more on how to trade like the smart money in upcoming videos, so stay tuned. Until next time, trade sharp, stay informed, and remember, it's not about predicting price, it's about understanding who's behind it.